I love how you talk about the strategies, and it's interesting to hear your perspective because you have such a depth and history in financial planning. And think about when you were 23 and got into the industry. Uh, you know, contrast the use of a universe of strategies, if you will, to what traditional financial planning used to look like when you first got into the industry and how the industry is evolving as a result of technology.
So what used to happen 20 years ago when you would meet with an accumulator, so Brent and Brooke, they're 25, they just got married, you would get what I would call an illustration. Brent, if you save 10% of your income for the next 35 years and your income goes up at 5% a year or whatever level you want it to be, you will have $1 million when you retire. And if Brooke does the same thing, she'll have $1 million and you're going to be fine. And so oftentimes you would end up with these 2-page illustrations that say you're starting with nothing, you're saving $500 a month or whatever the numbers are, and it increases over a period of time. And then at the end, it'll actually show you that you've saved a lot of money. And that would be the extent of it, because the wealth equation is time times the rate of return times the amount of money you put away. Got a lot of time, there's nothing to do there. The amount you're putting away, you're starting with nothing. And then the rate of return really will be the same in no matter what, because you shouldn't be manipulating that. It should be based on your risk tolerance. And so the only variable you have there is how much money can you pump away for how long. And so I think what happened was you went from illustrations where a lot of the tools were simple 2-page tools or a 4-page plan to no, there is more complexity. So for example, Stacy, TFSAs didn't exist when I started in the industry. Well, now that's a pretty important tool because I could have 150,000 set aside tax-free between Brooke and I if we were planning for it. And any income in there is tax-free forever and the growth is tax-free. Like that's a huge opportunity if you're not considering it. It has to go beyond illustrations. You look at housing, like the first house I bought for Brooke and I, we paid you're gonna laugh, 112,000 for a home. The second one was
120. So
yeah. Okay, well there you go. The second one was 270, and we blew the bank. Like Brooke and I were like I don't know. My dad's like, splurge, pay the extra 30,000 for the upgrades. I'm like, okay, we'll do it. And then we sold it for 310, and we were like, oh my god, we're minting money. But now, like, it's not uncommon for average house to be 600,000 or 700,000 if you're in a large city in Canada, and if you're in a big one, it could be $1 million plus. Like you need to understand what the consequences are of those actions. What happens? My mortgage rate, because we just moved, is like 1.59% for the next 5 years. But I asked my advisor 5 years out, what happens if that rate's 5% or 4%? Like, can we withstand it? And is there a risk there associated with it? And so the complexity of people having side hustles, people having new savings vehicles, housing market going crazy, different ways to buy products. Like no one is in the industry, in the fintech, is trying to put it all together for you. Maybe other than your company, where when I get an email from TD Insurance saying, "Hey Brent, you're under 50. We want to offer you $250,000 of life insurance," they're not really asking if I need it and how does it fit in my financial plan. They're just trying to sell the product for $30 a month, which is fine. And some people will buy it or not. But how do you get coordinated? And I think the only way you get coordinated is you need someone to put all the pieces together, and that's what your software can do. So the other thing is the amount of time. People never used to do a full financial plan because they would say, Stacy, it takes 2 hours to do the plan, and we know that the plan's going to change for Brent and Brooke. So what's the point in even doing it? What SAM allows you to do in the way that you gather data through a discovery conversation or a guided conversation, those are the questions you're going to ask in an initial meeting anyways. To create the plan, you literally can hit the button and in 8 minutes, you have a full plan. Like you're no longer bound to a 2 hour, I got to input everything and it's all manual. Now you can actually deliver a high quality plan with low resource expenditure from the advisor and the firm, but really improve the quality of the average plan that somebody gets. Even if they're an accumulator or maybe they're already retired, it becomes really simple to create a retirement plan as well.